Hey everyone, and welcome back. It's time for another deep dive, and let me tell you, this one's going to be a good one. We're checking in on the race to $10,000, that challenge we've been tracking for a couple months now.
Mm-hmm.
3 different portfolios, all trying to hit that $10,000 mark first.
Yep.
And we're looking specifically at December's results. So this is our December update
Yeah.
for the race to $10,000. And
Yeah, things are getting kind of heated.
I think it's fair to say that December was an interesting month for the markets as a whole.
Oh, absolutely. I mean, the market's been pretty strong since this whole thing kicked off.
Yeah, it's been pretty wild, honestly, to see, just how much growth has happened.
Yeah, it really goes to show you that the best time to invest is always yesterday, but the second best time is today.
Words to live by, for sure. So let's jump into it. We've got 3 contenders in this race, remember. There's the personal portfolio, a straightforward ETF fund, and then that totally wild community portfolio where every decision is made by
YouTube polls.
YouTube polls, exactly.
Yep.
So let's start with the personal portfolio. And this one's been making some, unconventional moves, let's just say.
Uh-oh, what happened?
Last time we checked, this portfolio was sitting at $310, and since then, an extra $500 has been added to it. But instead of going up like you might expect,
Yeah.
it's actually gone down to $954.
Interesting.
What's the deal with that?
So what's going on here is something called dollar cost averaging.
Dollar cost averaging, okay.
It's a strategy where you invest a fixed amount of money at regular intervals no matter what the market's doing.
Mm-hmm.
The idea is that over time, you'll end up buying more shares when prices are low and fewer when they're high.
Gotcha. So it smooths things out over the long run.
Exactly. And ideally, it brings down your average cost per share.
Okay. I can see how that makes sense theoretically. But,
Mhm.
actually seeing the value go down even after putting more money in, I don't know, it's a little unnerving, isn't it?
It can definitely feel counterintuitive, especially in the short term. But the investor here is really playing the long game. They're all in on this one company, Novi Medical Limited, ticker symbol EYE, and they see these dips as a chance to load up on shares at a discount.
Mm.
They're essentially saying, I believe in this company, and I'm going to keep buying even when everyone else is selling.
Wow. That takes guts. I'll give them that. So would you say this strategy makes you nervous? Or is it more like intriguing? Are you buying into this long-term vision?
I think it's definitely an interesting approach, and it really depends on your risk tolerance. Personally, I like to diversify a bit more. But hey, if you've done your research and you believe in the company's long-term prospects, dollar cost averaging can be a really effective strategy.
All right, fair enough. So that's the personal portfolio. Pretty bold strategy, let's say. Now let's take a look at the ETF fund. This one's looking a little less adventurous, shall we say,
Yeah, a bit more on the stable side.
which is up significantly from last month.
Looking good.
Yeah, and it's interesting. We also added $500 to this fund, just like we did with the personal portfolio. But the difference is
This one actually went up.
it actually went up, yeah.
Big surprise.
Big surprise, right?
Yeah.
And the $500 that we added went straight into IVV, which is a solid ETF that tracks the S&P 500.
Yep, nice and diversified.
Exactly.
Yeah.
So the big question here is, can actively managing a portfolio, like with a personal portfolio, actually beat just buying and holding a simple diversified ETF?
It's the age-old debate, active versus passive investing. And honestly, there's no easy answer.
Yeah.
There are definite pros and cons to both approaches.
Okay, so what are some of the pros and cons you're thinking of,
Well, with active management, you have the potential to outperform the market,
right?
but it also takes a lot of time and research. And let's be real, not everyone has the expertise or the stomach for that kind of risk.
True.
On the other hand, with passive investing, like with an ETF, you're essentially betting on the overall market. You're not going to get those crazy gains, but you're also less likely to experience those gut-wrenching losses.
Okay, that makes sense. So what are your thoughts on this whole experiment so far? Which strategy are you vibing with more?
That's a tough one. Right now, I'm leaning towards the ETF just because of the diversification and the lower stress level. But hey,
Yeah.
It's still early in the game. Anything could happen.
Absolutely. All right, let's move on to the wild card of the bunch, the community portfolio. This one's completely driven by you guys, the viewers. And let me tell you, it's been a wild ride.
Oh, tell me about it.
So far, it's sitting at $258, all thanks to the generous contributions of our amazing subscribers.
That's awesome.
Yeah, big shout out to all 41 of you who have chipped in so far.
We appreciate you.
We really appreciate it. Now, remember, this portfolio has a bit of a unique rule. The first stock we buy on the ASX has got to be at least $500.
Yeah, kind of like a mini boss battle before we can unlock the full potential.
Exactly. And I got to say, I am pumped to see what the community decides to invest in once we hit that $500 mark.
Yeah, the anticipation is killing me.
So if you haven't already, make sure to head over to the YouTube video and leave a comment with your ASX stock suggestion. Your idea could be the one that sends this portfolio to the moon.
Or to the depths of the market, but hey, that's part of the fun, right?
Exactly. High risk, high reward. So there you have it, folks. The December update for our race to $10,000.